$4.5 billion. That is the staggering sum siphoned from a sovereign wealth fund designed to eradicate poverty and propel a developing nation into the future. Instead of building infrastructure, these funds were meticulously drained to finance a dizzying global spree of unprecedented excess. This was not a simple bank robbery or a crude embezzlement scheme. It was one of the most audacious financial heists in modern history, orchestrated in plain sight through the very institutions entrusted with safeguarding the global economy. At the center of this labyrinthine deception stood a seemingly unassuming financier who cultivated an aura of absolute power and limitless wealth. He presented himself as a visionary advisor, leveraging political connections to launch what was supposed to be a strategic investment company for the public good. But beneath the polished exterior of diplomatic meetings and sovereign guarantees lay a meticulously crafted blueprint for catastrophic fraud. The architect understood a fundamental flaw in the financial world. If a lie is wrapped in enough complex paperwork, even the sharpest minds will fail to question it. The engine of this theft relied on the legitimate mechanism of sovereign bond offerings. To raise capital, the fund issued billions of dollars in debt, ostensibly to invest in energy and real estate projects. However, the true destination of these billions was obscured through a dizzying network of offshore shell companies. These phantom entities, registered in jurisdictions with strict corporate secrecy laws, were given names intentionally mimicking legitimate international businesses, creating a mirage of authenticity that fooled auditors and regulators alike. Moving such massive sums required a master class in creative accounting, a practice where financial records are manipulated to exploit loopholes and hide the true nature of transactions. Millions were categorized as standard consulting fees, while billions vanished under the guise of intercompany loans and joint venture investments that existed only on paper. The sheer volume of the transfers served as its own camouflage, overwhelming the standard compliance checks of the international banking system. But a fraud of this magnitude could not exist in a vacuum. It required the active, albeit sometimes willful, blindness of the world's most prestigious financial institutions. Investment bankers, lured by the promise of astronomical advisory fees, abandoned the rigorous investigative process known as due diligence. They ignored glaring red flags, bypassed internal compliance protocols, and effectively rubber-stamped the issuance of billions in debt, providing the essential credibility needed to legitimize the entire operation. Once washed through the global financial system, the stolen public funds financed a surreal reality of grotesque consumption. Court documents later revealed that billions were diverted to purchase a $250 million superyacht, ultra-luxury real estate in Manhattan and London, and priceless works of art. The money even flowed into Hollywood, funding major motion pictures that ironically depicted tales of financial excess and corruption. It was a brazen display of impunity, fueled by money meant for the citizens of a developing nation. How does an entire ecosystem of highly educated regulators, auditors, and bankers collectively fail to notice a multi-billion-dollar black hole? The answer lies not just in systemic vulnerabilities, but in the psychology of institutional greed. When the fees are high enough and the political connections seem powerful enough, a dangerous cognitive dissonance takes hold. The participants chose to believe the grand narrative of sovereign wealth, ignoring the increasingly desperate whispers of financial impossibility, because the illusion was simply too profitable to shatter. The collapse of this towering house of cards did not begin with a regulatory audit, but with the courage of internal whistleblowers and relentless investigative journalists. Leaked emails and thousands of pages of confidential financial documents slowly found their way into the hands of reporters. As investigators later uncovered, the meticulously constructed facade began to crack when the fund repeatedly missed interest payments on its massive debts, forcing a desperate scramble to cover the shortfall and exposing the hollow core of the enterprise. What followed was an unprecedented global dragnet. The United States Department of Justice launched its largest ever kleptocracy asset recovery initiative, filing civil forfeiture complaints to seize billions in stolen assets scattered across the globe. International warrants were issued, high-ranking political figures were arrested, and the prestigious financial institutions that facilitated the theft were slapped with record-breaking multi-billion-dollar fines. The legal fallout spanned continents, laying bare the interconnected nature of modern financial crime. Yet, amidst the spectacular asset seizures and corporate penalties, the most profound devastation was quietly absorbed by the public. The citizens of the defrauded nation were left to shoulder a crushing burden of sovereign debt, effectively mortgaging their economic future to pay for the extravagant crimes of a few. Vital infrastructure projects were canceled, public services were strained, and the fundamental trust between the people and their government was deeply, perhaps irreparably, fractured. The legacy of this scandal forced a brutal reckoning within global financial markets. It exposed severe blind spots in international anti-money laundering frameworks and highlighted the dangerous ease with which offshore secrecy jurisdictions can be weaponized. Regulators worldwide were forced to reevaluate the efficacy of their oversight, recognizing that traditional compliance models were woefully inadequate against state-sponsored actors utilizing sophisticated cross-border corporate structures. Ultimately, this monumental heist stands as a dark monument to the era of globalized finance. It serves as a chilling reminder that the architecture of modern wealth is only as secure as the integrity of the individuals tasked with guarding it. As long as the global financial system prioritizes the frictionless movement of capital over rigorous transparency, the blueprint for the next multi-billion-dollar deception remains hidden in plain sight, waiting for the next architect bold enough to exploit it.